Silver has had a habit of looking weakest right before it forces institutions to reveal where the stress actually sits. Today's pressure isn't chaotic and it isn't emotional. It's controlled, mechanical, and quietly deliberate, which is why it deserves closer attention before the next layer becomes visible. Right now, the tape tells a story that doesn't match the surface commentary. Price weakness appears orderly, almost polite, with no panic bids and no disorderly selling. That kind of behavior usually signals positioning rather than fear, and it raises a question about who benefits from keeping silver subdued at this moment. Underneath the daily moves, liquidity behavior is doing something subtle. Offers remain available, but they thin out faster than expected when size appears. That doesn't scream confidence, and it doesn't signal collapse either. It suggests someone is managing exposure carefully, waiting for a condition that hasn't arrived yet. What makes today different is timing. Pressure on silver is arriving while other risk assets aren't sending consistent signals. Correlations that usually tighten during stress are loose, almost indifferent. When relationships break down like that, it's rarely random, and it hints that a larger adjustment may still be forming. There's also the matter of patience. Short-term participants seem active, but longer-term players aren't reacting with urgency. That absence matters more than volume spikes or intraday volatility. When experienced capital stays still during weakness, it often means the real decision point is still ahead. This is where narratives become dangerous. It's easy to frame today as simple downside continuation, but the structure doesn't fully support that assumption. The pressure looks applied, not discovered, and that distinction tends to matter later, when positioning stops being optional. Even sentiment data, where available, refuses to lean decisively bearish. It's cautious, yes, but not capitulatory. That kind of restraint usually precedes either a deeper push, lower, or an abrupt reversal, and the market hasn't yet shown which path it's prepared to tolerate. The uncomfortable truth is that silver under pressure doesn't always mean silver is weak. Sometimes it means something else is being protected, delayed, or prepared. And until that motive becomes clearer, today's calm pressure may only be the opening move. At the institutional level, silver rarely moves first when broader stress is building. It reacts after positioning elsewhere has reached its limit, which makes today's pressure feel less like an isolated event and more like a response to something already in motion. One of the quiet signals comes from how quickly rallies are being capped. Each attempt higher meets supply almost immediately, not aggressively, but with enough consistency to discourage momentum traders. That kind of behavior suggests intent rather than conviction, as if price is being guided, not fought. At the same time, downside follow-through remains restrained. Breaks don't accelerate. They hesitate, pause, and stabilize just enough to prevent panic. Markets that truly want to fall don't behave this way, and that hesitation introduces an uncomfortable ambiguity. Behind that ambiguity sits positioning risk. Large players appear unwilling to press shorts aggressively, even with price cooperation. That restraint implies concern about liquidity conditions if the trade goes too far, a concern that usually doesn't surface unless something beneath the market feels unstable. There's also the issue of time exposure. The longer silver stays under pressure without resolving lower, the more expensive that pressure becomes to maintain. Carry costs, margin considerations, and opportunity costs start to matter, and those pressures don't show up on a daily chart. What's notable is the absence of narrative reinforcement. There's no dominant macro headline forcing silver down, no single data release that explains the behavior cleanly. When markets move without a clear story, it often means the real driver isn't public yet. Even intermarket signals remain oddly muted. Metals aren't diverging dramatically, currencies aren't screaming risk off, and rates aren't delivering a decisive verdict. That kind of neutrality tends to precede sharper moves, not follow them. The danger for anyone reading today's price action too literally is assuming the move has already finished its work. History suggests these controlled phases are often preparatory, and the question is whether silver is being leaned on to buy time or to test tolerance before something larger breaks. Historically, when silver is pressed without volume expansion, the market is negotiating rather than concluding. Today fits that profile, and the negotiation appears to be taking place between risk management desks, not speculative hands. One clue lies in how quickly volatility collapses after minor spikes. Each burst of movement is absorbed almost immediately, as if participants are deliberately smoothing the surface. That kind of volatility suppression usually reflects a desire to prevent signaling, not a belief that risk has disappeared. Beneath that calm, inventory behavior becomes harder to ignore. Available data suggests there's no visible surplus driving this pressure. Flows look steady, not abundant, which removes one of the usual explanations for sustained weakness and shifts attention toward balance sheet decisions instead. Another layer sits in how derivatives are being used. Activity appears focused on maintaining ranges rather than extending trends. That choice limits upside damage, but it also caps downside efficiency, trapping price in a zone that feels intentional rather than organic. What complicates matters is the broader backdrop. Other assets that normally absorb stress aren't behaving like pressure valves. They're holding almost stubbornly, which increases the likelihood that silver is being used as a temporary outlet rather than a final release. There's also a psychological element at work. Repeated failures to rally wear down confidence without creating fear. That erosion is subtle, but it's effective, and it often precedes moments where positioning flips faster than sentiment can adjust. Yet for all that pressure, there's still no sense of urgency. Settlement behavior remains orderly, and there's no scramble for protection visible on the surface. Markets usually telegraph distress before it erupts, and that signal hasn't appeared yet. That leaves silver sitting in an uncomfortable middle ground, neither weak enough to flush positions, nor strong enough to force repricing. Those conditions rarely persist for long, and when they break, the direction tends to surprise those who assume today's calm pressure told the full story. Behind closed doors, the conversation around silver isn't about today's price. It's about exposure duration, counterparty confidence, and how much uncertainty can be carried without triggering secondary effects. One of the quieter shifts is in how risk limits are being treated. Instead of expanding with favorable price movement, they appear static. That suggests desks are less interested in pressing advantage and more focused on preserving flexibility, a posture that usually emerges when visibility is limited. Settlement dynamics add another layer. There's no evidence of stress, but there's also no sign of excess comfort. Obligations are being met, yet they're being managed carefully, as if participants are unwilling to let buffers thin too far. What's striking is the lack of emotional response from longer-term holders. They aren't chasing dips, but they also aren't exiting in size. That indifference can be more telling than panic, because it implies expectations haven't been reset yet. Short-term traders feel the squeeze differently. Tight ranges and fast reversals punish conviction, slowly draining participation. When markets behave this way, they often aim to reduce noise before making a statement that can't be ignored. Macro alignment remains incomplete. Inflation expectations, policy signals, and growth data aren't delivering a unified message. Silver, caught between those forces, ends up absorbing uncertainty rather than expressing a clear view. This is where misinterpretation becomes costly. Weakness without confirmation can lull participants into assuming stability, even as pressure builds quietly through positioning and time. The longer silver stays pinned under this controlled weight, the more meaningful the eventual release becomes, not because of price alone, but because of what that release will say about where stress has been hiding. For decades, the most consequential moves in silver have emerged after periods when nothing seemed urgent. Today's pressure fits that pattern uncomfortably well because it's draining energy without resolving imbalance. One detail that keeps resurfacing is how quickly interest fades near obvious levels. There's no aggressive defense, but there's also no surrender. That standoff suggests participants are waiting for permission, not reacting to necessity. Funding behavior adds texture to the picture. Costs aren't flashing warning signs, yet they aren't easing either. That neutral tension often signals a market being held in place, rather than one finding its own equilibrium. What's absent is just as telling as what's present. There's no rush into alternatives that would normally benefit from silver weakness. Capital isn't rotating decisively, which hints that today's pressure may be more about containment than conviction. Across desks, risk conversations tend to shift before price does. When managers start focusing on optionality instead of direction, it usually means they expect conditions to change faster than models can adapt. Silver's role in that context is awkward. It's liquid enough to absorb positioning, but sensitive enough to transmit stress if misjudged. That makes it a convenient tool, but also a dangerous one if pressure exceeds tolerance. The market seems aware of that balance. Every push lower is measured, almost cautious, as if no one wants to be responsible for breaking the structure prematurely. That caution is revealing. It suggests the real risk isn't in today's downside, but in what happens when restraint gives way to urgency, and silver stops being managed and starts reacting. Historically, when restraint dominates silver trading, it reflects uncertainty about consequences rather than confidence in outcome. That distinction matters now, because today's pressure hasn't clarified anything. It's only narrowed the range of acceptable scenarios. One subtle shift is in how quickly information is discounted. Data that would normally spark follow-through barely registers, as if the market is deliberately refusing to commit. That behavior often appears when participants suspect the signal itself may be misleading. Position adjustments appear incremental, not decisive. Exposure is trimmed, rebalanced, and reshaped, but rarely abandoned. That kind of activity suggests preparation, not retreat, and it usually precedes a more forceful adjustment later. What complicates the picture is external fragility. Other markets show signs of tension without confirmation, creating an environment where silver's movements are scrutinized for meaning they may not yet carry. There's also a growing asymmetry in risk perception. Downside is being treated as manageable, while upside is quietly respected. That imbalance doesn't show up in headlines, but it shapes how orders are placed and how quickly they're withdrawn. The longer this persists, the more it conditions behavior. Traders stop reacting to small moves, which allows larger moves to travel further once they start. That psychological shift often goes unnoticed until it's too late. None of this implies inevitability. It implies sensitivity. Markets under pressure like this don't need a catalyst so much as a miscalculation. And when miscalculations happen in environments defined by restraint, the response tends to be disproportionate, catching those who mistook calm for stability off guard. At the institutional level, the most revealing moments often arrive when patience starts to wear thin. Silver hasn't reached that point yet, but the signs of fatigue are beginning to surface in how narrowly risk is being tolerated. Execution behavior has grown more selective. Orders appear and disappear quickly, suggesting sensitivity to being seen. When participants start hiding their intent, it usually means they're unsure how the next move will be interpreted. What's notable is how quickly minor imbalances are corrected. Any deviation is met with immediate adjustment, keeping the structure intact. That level of attention implies the structure itself has become the priority, not the direction. There's also a quiet shift in expectations. Conversations are less about price targets and more about reaction scenarios. That change in focus often precedes periods where speed matters more than precision. Silver's dual role complicates that shift. It functions as both an industrial input and a financial instrument, and pressure on one side can spill into the other without warning. Managing that overlap becomes harder as uncertainty rises. The longer this balancing act continues, the more fragile it becomes. Stability maintained through constant intervention tends to fail suddenly, not gradually. What's missing is a release valve. Without a clear outlet, pressure doesn't disappear. It redistributes, often into places least prepared to absorb it. And when that redistribution finally shows itself, silver is rarely the source of the shock, but it's often where the shock becomes visible. For decades, the final phase before repricing has looked deceptively quiet, and silver often sits at the center of that silence. What we're seeing now carries that same uneasy familiarity. The pressure today hasn't produced clarity, only compression. Ranges tighten, reactions dull, and participation thins just enough to make sudden movement more impactful when it arrives. That compression isn't neutral. It's a condition that amplifies mistakes. What stands out is how little tolerance there appears to be for surprise. Every unexpected move is smoothed out quickly, as if preventing discovery has become more important than allowing it. Markets don't behave that way unless discovery itself feels risky. There's also a subtle shift in accountability. Decisions seem designed to be reversible, temporary, and deniable. That mindset tends to dominate when confidence in longer-term assumptions begins to erode. Silver's position in this environment is uncomfortable. It's visible enough to signal stress, but small enough to be pressured without immediate consequences. That combination makes it an early indicator, not a final verdict. The danger is assuming today's control guarantees tomorrow's stability. Control requires constant input, and constant input creates dependency. Once that breaks, moves tend to travel further than anyone expects. None of this suggests an immediate outcome. It suggests proximity. Pressure of this type doesn't dissipate quietly. It resolves through revaluation or reallocation. And when that moment arrives, today's calm weakness may be remembered not as a warning sign, but as the last period when silver was still being held in place. What makes this moment difficult is that nothing looks broken. Silver is under pressure, but the system around it still functions, still absorbs, still pretends that today is just another session. That illusion has held before. right up until it didn't. When markets manage risk instead of expressing it, signals arrive late. By the time clarity appears, positioning has already shifted and reactions become reflexive. Silver's current behavior fits that uncomfortable gap between awareness and response. The calm isn't reassurance. It's evidence of effort. Effort to keep relationships intact, effort to prevent signaling, effort to delay decisions that can't be easily reversed. Those efforts tend to intensify right before they fail. This is why focusing on direction misses the point. The real issue isn't whether silver moves higher or lower next, but whether the pressure being applied can continue without consequence. History suggests that balance rarely holds indefinitely. When resolution comes, it won't announce itself cleanly. It will arrive as a small break that doesn't recover, a reaction that travels further than expected, or a correlation that refuses to snap back into place. By then, today's weakness will no longer matter. What will matter is what the market was trying to protect, postpone, or disguise while silver sat under controlled pressure. And that's the part most people won't see until after it's already happened. What makes this moment difficult is that nothing looks broken. Silver is under pressure, but the system around it still functions, still absorbs, still pretends that today is just another session. That illusion has held before, right up until it didn't. When markets manage risk instead of expressing it, signals arrive late. By the time clarity appears, positioning has already shifted and reactions become reflexive. Silver's current behavior fits that uncomfortable gap between awareness and response. The calm isn't reassurance. It's evidence of effort. Effort to keep relationships intact, effort to prevent signaling, effort to delay decisions that can't be easily reversed. Those efforts tend to intensify right before they fail. This is why focusing on direction misses the point. The real issue isn't whether silver moves higher or lower next, but whether the pressure being applied can continue without consequence. History suggests that balance rarely holds indefinitely. When resolution comes, it won't announce itself cleanly. It will arrive as a small break that doesn't recover, a reaction that travels further than expected, or a correlation that refuses to snap back into place. By then, today's weakness will no longer matter. What will matter is what the market was trying to protect, postpone, or disguise while silver sat under controlled pressure. And that's the part most people won't see until after it's already happened. When resolution comes, it won't announce itself cleanly. It will arrive as a small break that doesn't recover, a reaction that travels further than expected, or a correlation that refuses to snap back into place. By then, today's weakness will no longer matter. What will matter is what the market was trying to protect, postpone, or disguise while silver sat under controlled pressure. And that's the part most people won't see until after it's already happened.